if you look at estimates of growth for next year, it's above potential, at or above potential. So it's not as if the Fed is particularly restrictive. What seems to be its focus is more on the sort of K-shaped nature of the U.S. recovery, that there are people who are hurting, especially in the lower middle class. The affordability crisis is an important issue. And so it's trying to keep their jobs. Though, of course, another answer would be to try bringing down inflation, which hurts the people at the bottom much more. But it's chosen one over the other of its mandates. In the meantime, the U.S. economy is chugging along really strongly with enormous investment in AI-related stuff. And with the upper middle class really buoyant on the backs of enormous stock gains and housing prices remaining stable rather than, coming down because of high interest rates and low volumes. So all in all, it looks like things will start picking up again in the U.S. as we go into next year, barring something unforeseen on the political front, which, of course, can never be discounted.
So there's a greater likelihood, in your view, that the Fed continues to stay dovish?
I think the Fed at this point has done enough to claim that it's bought insurance for the economy. It's probably been more dovish than certainly I would have been under the circumstance. But again, one of the issues it's battling with is very, very gray data because, as you know, the government shutdown prevented data on the labor market coming out. So in that kind of situation, it's preferring to be a little more dovish and hopefully buy insurance for the economy. Of course, the risks are that it starts precipitating excess inflation, but also excess credit growth, and that's a concern.